just reflecting on this super bubble that's forming, according to Grantham. He says the checklist is there. The crazy behavior was last year. We've run through phases. We're now complete, and the wild rumpus can begin at any time. He's expecting one of the largest potential markdowns in perceived wealth in U.S. history. Do you think we are in the foothills at the beginning of a super bubble implosion? Good morning.
Good morning. Well, obviously, you know, when Jeremy Grantham speaks, you listen because he has such an important and impressive track record. So I have the utmost respect for him in this regard. That being said, if I look at the current conditions in terms of global growth, in terms of what the central banks are actually saying they're going to do, then I don't think we've quite reached the point where I would say that the real economy is pointing us and monetary policy is pointing us to an imminent implosion in stock market valuations, because that's really, of course, the nexus of what he's calling for, a very large re-rating of equity market valuations. And we just don't think that's in the cards. You know, corporate profitability outlook is pretty strong, and we think that markets should be able to sustain a large part, if not all, of the current valuation levels going into 2022. So we're a little more optimistic than Jeremy in this regard.
Well, it sure sounds more than just a little bit optimistic, Wouter. So let's build on that. GTV Go for our clients. The drawdown in the month of January in U.S. equities, $3 trillion that have flowed out in terms of the market cap. That's the largest drop since COVID. Is this the opportunity to get back in? And where do I get back in?
Sure. I mean, obviously, this is a drawdown, and we are noticing a fairly impressive rotation between, especially the value and growth side of the equity market spectrum. That is not unusual. This happens time and again, especially around the start of a rate hike cycle. We think that what's happening now is really the market sort of calibrating its outlook and finding its footing, hopefully, in what we still think is a pretty solid economic and corporate earnings outlook. But that being said, I mean, obviously, if inflation turns out to be much more persistent than we currently expect, and therefore the monetary policy response turns out to be more aggressive than we expect 2 to 3 rate hikes from the Fed, where close to 4 have been priced in, then, of course, downside risk does rise, and that risk scenario does come to the fore. But that's not our base case scenario. So we're pretty close to looking at this as an opportunity as opposed to a threat.
Okay, so we're going to possibly see you buy the dip, which has, we know, worked very, very well in the past. The other narrative from Grantham is that the bond market offers so little protection, it's absolutely useless. PIMCO would disagree with this. So two sides of the trade. When you look at bonds, sovereigns in the US, are they potentially now a haven, in other words, quite tantalizing at this yield, or are they just quite simply another basket of hell?
No, we look at the US 10-year market as a bit more evenly balanced between those two extremes that you've laid out. So our central tendency for the US 10-year is 175 in a range of 150 to 2%. So we're very close to that level, which means that we think it's pretty evenly priced. That took into consideration the fact, again, that we think the Fed is likely to do a little less on the rate hike tightening, the rate hike increases than markets are pricing in. Also, the quantitative tightening side of things, we think is going to be cautious and gradual, because we simply need to find out how much of this inflationary cycle that we're currently in is persistent and how much of it is transitory. The Fed needs to find that out as well. So we do think that the bond market offers a fair value point at this stage, and should we shoot higher above that 2% level on the 10-year, we will probably look at it as a buying opportunity, much more aligned with the PIMCO view on that part.
Wouter, I mean, the last 14 years have seen American exceptionalism in the global stock market. And I look at some of the gauges, including the MSCI World Index, ex-United States, and that's now broken out of the downtrend and starting to shine more than their U.S. peers, which, you know, looking back the last 14 years is not a find. Is that just a one-off, or do you think that may be actually playing out longer term?
So it's certainly a very interesting development. I mean, again, it's a reflection, we think, in large part of that value versus growth transition, with the markets now shifting into value versus the previous growth bias. Europe, for instance, has a much larger value tilt than the US market does. So it's a reflection of that same trade. And we do think there's room for that trade to run, again, given the fact that we do see this interest rate environment around current levels persist. That's been the catalyst for this repricing. We think that's going to persist during 2022. At the same time, of course, where previously value actually had lower earnings growth, higher earnings growth expectations at a lower valuation level, that's no longer the case. Now growth once again has higher earnings growth expectations. So that does taper our expectations in terms of how far this value catch up can go. So it is contained in that sense.